Hey everyone, welcome back to the Your Money Your Life podcast. We are at episode 226 of the podcast. Make sure wherever you're listening, you like, subscribe, 5-star rate and review. If you're watching on YouTube, do the same thing. Also, hit the notification bell on YouTube so we know every time we drop a new episode, as we are doing now. Now, let's get into it. There is certainly a lot to talk about. First and foremost, let's take a look at the market. We have the market last 5 days up right now. We're down about a little bit over 1.5% so far in the last 5 days. Over the course of a month, we're up 3%. So this last week has been a little bit of a pullback, and primarily you're seeing different earnings come out, and you're also seeing new PCE numbers come out. So let's dive into what the stock market is saying. First and foremost, Salesforce slid. We'll talk about that. The Dow is just dropping a little bit. We'll talk about why that is. Um, so we have a shortened trading week. As you know, we had Memorial Day. I just got back from a trip myself with a lot of good friends, so I'm feeling good. Got a time to relax and take a personal vacation. So the big thing here, we're getting more numbers on personal consumption, like the PCE. We're going to get those numbers Friday, which is going to be for last month, for April. And that's the Fed's preferred inflation gauge. So personal consumption expenditures. We'll get more numbers on that. The NASDAQ has done decently well over the past month. Again, we'll talk about more why that is. A lot of that's earnings. A lot of that's the AI surge. A lot of that's NVIDIA surge. We talked about that last week. So the sentiment investors right now is just waiting to see more data on inflation and waiting to see how earnings are shaking out because a lot of companies are moving different ways on earnings. So we can even take a look at Salesforce. Let's jump into current updates of the week. Salesforce slid. They announced their earnings and they missed out on first quarter revenue and they had weaker than expected outlook. And that's why the stock took a double-digit tumble today, early this morning, and is trading lower today as we track it if you're listening on Thursday. So it's one of the worst 2 days in trading that they've had in decades. So the software giant is expecting, they now expect bread and butter subscription and support business to tick up under 10% for the fiscal year, a slight revision downward. And professional services and other revenue saw a year-over-year decline of 9%. So Salesforce is really saying that their business is slowing down. People are spending less on enterprise services, it seems like, in their realm anyways. Um, and they're looking to try to lean more heavily into AI. I don't know how that's going to factor into Salesforce business, but that's a pretty substantial move for Salesforce. They've done a lot of acquisitions to bring in inorganic growth by buying different companies. They've done that a lot, and they're offering a lot of different services and business and SaaS. But it seems to be a little bit of slowdown for them. So the Salesforce, as you saw, their stock dropped a bit. So that's really interesting to see. Other companies that had earnings and didn't do that well was Kohl's, or the big box retailer. I mean, I haven't shopped at Seen Kohl's in like 2 decades, right? What I'm like, this is a company that is, again, they missed on revenue expectations, so their top line wasn't really growing, and they had a surprise loss per share. So that means that they're not curtailing their expenses well enough to combat the loss in revenue, or the slowdown in revenue, I should say. So they reported a net loss of 27 million or 24 cents per share. Compared with a year ago, they had a profit of 14 million and 13 cents per share profit. So their sales decreased. The company also lowered its guidance, meaning they see the rest of 2024 not doing that well in comparison to what they had earlier on guidance. So the stock dropped 24% or 25% on its news. So again, Kohl's struggling. Foot Locker, on the other hand, had a surge of 30% as they're showing its signs of life and a turnaround. They posted better than expected comparable sales. So comparable sales is a metric a lot of big box retailers use. And they also are working to reverse an ongoing sales slump by revamping its stores and winning back brands. They want to bring back brands to wholesale at their Foot Locker, to have their brands there, to be able to sell the stuff that they need to sell, to fill the needs of consumers. The revenue came in line at 1.8 billion. They reported a net income for the 3-month period ended May of May 4th was 8 million or 9 cents per share. So the company did well and they're having a turnaround. So their CEO, Mary Dillon, congrats to her, a female CEO that seeming to try to do her best, turn around a brand that was struggling, fledgling, all the things, and now she's doing a great job of doing so. So those are two widening spectrums of what companies are doing right now. It's hit or miss on these earnings. Some businesses are accelerating, some are slowing down. And it's really not pinpointed on a certain industry, as far as I can tell. It's just really, I guess, strategy in this market. When things slow down, when everything's not just straight up, strategy is super important. And then the companies, the management team, the CEO is the one that's going to push the strategy. Why are things going down? Consumers seem to be pushing back on high prices. So the US economic growth advanced at a slight or modest pace in the past month based on the Fed's Beige Book survey of 12 regional business districts. So there were signs that consumers had started to take a stand against higher prices, which rose at a modest pace during the period. So the pushback from consumers was evident in retail spending. So we just talked about a couple of retail stores, one doing better, one doing not so great. But again, that's part of the strategy that has to play a part when people and consumers are slowing down and taking a better, more look at prices because people are pushing back. There was a viral McDonald's post showing that the Big Mac, the cost of a Big Mac meal has surged to $18. So they were like comparing it like a decade ago or 2 decades ago versus the cost now. And it was like crazy cost increase, right? And a lot of that's the last past 3 years. The inflation over the past 3 years has been unprecedented. The numbers being stated by the government, a lot of people think it's a lot higher than what is being stated. People feel it. People feel it in the wallet. Highs from the Fed's Beige Book, labor market cooled in several regions, reported that wage growth was normalizing back to pre-pandemic trend. Profit margins are smaller as firms are less successful in passing along higher input costs. So a lot of these things are happening. And again, the consumer is what I talked about on CNBC a couple weeks ago, is the biggest linchpin in what's going on economically. And that's going to play a huge part. So watching how the trends are in consumer prices, um, and how consumers push back against that is going to be really, really important. So another story that I thought was interesting, Sony is in talks to buy Queen's catalog. So Sony Music is in talks to buy Queen's catalog for 1 billion, potentially the largest ever deal of its kind. This is by anonymous sources. So the music label is working with another investor on the acquisition, which includes hit songs such as Bohemian Rhapsody and We Will Rock You, as well as merchandising. Discussions are ongoing and may not result in agreement, but a deal would follow Sony's purchase of a stake in Michael Jackson's catalog for 600 million earlier this year, per Billiard. Sony bought Bob Dylan's catalog in 2022. Okay, so I think this is an interesting story because a lot of people don't understand the like how music catalogs work, right? Like, so if you're a musician, if you own your publishing, if you own your rights, if you own your residual rights and different things of that nature, you can get paid off of every time your music is played in different places or licensed in different places or used in different places, right? So that cash flow you can actually sell. So if you're someone that has a long-lasting catalog, like what Queen was popular in the 90s, I don't even know. Um, if you're someone that had a long-lasting catalog, you can sell that cash flow to a bidder, to a buyer, based on a valuation that you guys come to, based on the cash flow and expected cash flow. So Sony looking to buy Queen's catalog for 1 billion. That's a pretty high number. Like, I feel like the largest catalog to date is probably like Michael Jackson's. I mean, Sony bought a stake for 600 million. That's just a stake, right? Like that's probably a minority stake. Michael's catalog is huge, and Michael Jackson even bought a catalog. I think he bought the Beatles catalog. It's actually a funny story of how he did it. So if you are ever interested, look up that story of how he bought the Beatles catalog. So there's a lot of this trading hands. I think Justin Bieber sold off some of his catalog rights. I've seen a lot of people do it. Some producers have sold out their catalog rights. So you get a large lump sum payment for someone to take you expect the future dividends or cash flow or residuals of your music. So a lot of that's happening. There's even funds out there that are buying catalogs and looking for ways to implement them in different places to increase the cash flow, right? You can try to look for other places for it to be licensed and used, increase the cash flow of said catalog. So really interesting, for people to look into and figure out how that all works. NCAA, there was a big story about the NCAA. So you guys are all familiar with the NCAA. They agree to pay athletes directly as the college compensation battle rages on. So some student athletes might soon be switching from ramen to ribeye. So colleges earn billions off their players. We've known that for years. They never handed out paychecks, but now that could change. The five biggest athletic conferences agreed last week to an antitrust settlement that, if approved, would allow colleges to pay athletes directly. 14,000 current and former college athletes will receive a share of a 2.8 billion settlement. The lawsuit at the center of this case could have resulted in 20 billion in damages for the NCAA. Athletes could get up to 1.5 billion per year under the new model. The playbook is that the universities will be allowed, but not forced, to share up to 22% of their yearly sports revenue with athletes as early as fall 2025. So yeah, and I was just going to say, it says FYI, pro league revenue splits are about 50-50. So how these work, 'cause I'm obviously as an agent, I know a bit more about this than most people do as far as the revenue splits, but they have a collective bargaining like the NCAA, or excuse me, in the professional leagues have a players association that negotiates the terms of their players being able to work with the league and the owners of the league via a collective bargaining agreement that divvies up all the things that counts as revenue for the league and how that's split between owners and players. And so when you're talking about pro leagues, it's about 50-50. It sounds like playbook for the universities will be 22%, which I know will be increased. It's going to be pretty much amateurism, pro amateurism at some point, right? Like that 22% is obviously a lot lower, and it's going to have to be negotiated up. I'm sure lawyers are like starting to work and create a NCAA association where they negotiate with all the conferences and all the colleges on increasing that over time and all the different stipulations that go into a collective bargaining agreement, which is a lot of different things. It's going to be pretty much semi-pro, right? Like very soon, right? In our life, like less than nothing, like 5-10 years, that's what's going to be. So Division One sports generated nearly 16 billion in revenue in 2019, and 18% of that went back to the athletes through scholarships and medical treatments. But there's been a push to compensate student athletes more like employees. And so that's really, really what's happening here. And so it's going to be an employee-employee relationship, a collective bargaining agreement coming down the pipeline. We're working with some of the top athletes on their NIL deals, on different things for them as they continue to figure out what they're going to do as they move into the professional ranks in short matter. Faster settlement time. This is actually really great. Wall Street traders are settling at the fastest pace in a century as SEC tries to cut risks. So, one of the biggest challenges to Wall Street trading in a century, as of yesterday, trades of U.S. stocks, bonds, ETFs, and some mutual funds now settle with one day, aka T+1, instead of two. So remember, when I work with a client and someone needs liquidity and we sell stock, it takes 2 days for that sale to settle into withdrawable cash. That's just a regulation, right? So you can't just sell and pull the money out right away. It used to take 2 days, but now we're moving to a one day settlement, meaning when you sell, it takes one day for it to be settled into cash that could be withdrawable. So since 2017, US exchanges followed the T+2 policy, meaning it took 2 business days for clearinghouses to verify funds and transfer stocks. Now that background works has been expedited as SEC looks to reduce the likelihood of issues arising between when a trade's made and when it's settled. So that's actually an important point. Like when you make the trade, or if it takes a couple days for it to settle. If things different happen, if stock, like it just the shortened period is better, right? And so this T-2 to T-1 or +1, excuse me, is going to be a better move for investors and more liquidity move overall. So quite interesting. Love it. And let's see, is there more AI news? OpenAI's mega Wall Street Journal license deal could reshape news and publishers choose sides on AI. But ChatGPT is about to consume a lot more articles about ChatGPT. Wall Street Journal owner News Corp and OpenAI sealed what appears to be the largest AI news license deal ever, said to be worth 250 million plus over half a decade. The partnership will give OpenAI the right to use articles from News Corp brands like Wall Street Journal, MarketWatch, New York Post to answer user questions and train its bots. Okay, so they have a licensing deal to be able to use Wall Street Journal articles to train AI bots, to train the AI algorithm. They have similar licensing deals with publishers, including Axel Spring, Dotdash, and others, Associated Press. Google's reportedly paying small outlets to produce articles with AI. So again, this information that the algorithms use to actually train itself, and they get information from you, they get information everywhere. A lot of that information data is protected, right? And so you have to buy it. You can't just like steal it. You have to buy it. You have to license it. And so that's what these algorithms are going to have to do. And it's going to cost a lot of money. I mean, they're just scaling. They're just going to say, hey, we'll just pay whatever it takes to scale. Because once we do scale, and we train our algorithm enough, there's really nothing that can stop it, right? Like it has enough data, it'll just start training itself in a sense, right? So that's why they're just paying up whatever it takes because they just want to get as many users as possible. That's the name of this game when AI with AI is get as many users as possible. And to do that, you have to train your bots better than anyone else is training them with the most information, right? And so that's why I've liked Google, a lot of companies that have information already. If you think of search and different things that they'll be able to gather just from search itself and information encoded in there, going to be incredible. Really going to be incredible. This is an interesting story. Hollywood had a tough weekend. So Memorial Day weekend gross sales really down. Yeah, there's no good movies. Me and my fiance watched Civil War yesterday. I didn't even get it. That was like the dumbest movie I've ever watched. Like, there's no good movies recently. Movie times just not movies are just not the same. There's no good movies right now. So I can understand the box office taking a hit. We're gonna see Strangers Chapter One. We still haven't seen it. But yeah, no good movies out right now. Let's dive into what I like to call personal finance question of the week. And this week we have a few that I thought were pretty interesting. The first one was, what is the average age of a car on the road today? Average age of the car on the road today. I think they said it increased because 2010 they started making really good cars, so it actually increased. Actually, I think I saw the answer. I think it's 12 years. Yes, it is 12.6 years. I was actually reading a weird article. I just ran across it on Twitter, I believe, where it said in 2010 cars safety and everything mechanics everything got better, started making a lot of good cars, so the average age of a car on the road is 12.6 um right now, 12.6 years. So interesting enough. I thought that was interesting. Let's move into consumer question. How much does an average overnight hospital stay cost? I'd say a couple $100, few $100. I don't know. Oh, answer. How much is an average overnight hospital? Average overnight hospital stay. Okay, wow. It actually says 11,700. So according to data from the Agency of Healthcare Research and Quality, most hospital stays hover around an average of 11,700 per day. Wow, that's crazy. Of course, insurance, I'm assuming, covers most of that. But wow, that's pretty crazy. Didn't know that. Let's move on to our last one. Let's do our last one. What is the one thing that make Americans feel wealthy? I think it's time. Having time, sense of well-being. Interesting. Well, interesting. What does that mean? Sense of well-being? I think stability, financial stability. For me, I think it's time. So let's see. This is a survey done by Charles Schwab. Actually, it's a definition of wealth. 40% said the sense of well-being. 32% said money. 26% said assets. 25% just said having necessities. 15% said freedom. 13% achievements. 11% luxury. 9% giving. Of course, giving at the bottom there. But that's really how it rocks out. That's quite interesting. Well, folks, this was actually a really high energy, fun podcast. Make sure, of course, you share this with your family and friends as we keep rocking on. We do this every week, and we will see you next week.